Hi, I'm Renee. I'm Tanya. This is Renee Morales with eXp Realty, and we would like to welcome our host today, our guest today, Bill Neville with the Entrust Group, and he is going to share some information about how to build wealth with your self-directed IRA. So, thank you, Bill, for being with us today and with sharing the information.
Yeah, thanks for having me. I mean, specifically, we're going to focus on investing in real estate inside your IRA. Let me start my share screen, and then we'll get right into it. So, creative real estate investing using your IRA by the Entrust Group. Let me start right into this. First of all, to clarify our role in the process, Entrust does not give advice. We don't sell investments. We don't promote or recommend or endorse any particular investments. We are strictly a retirement account custodian and record keeper. So we're not a fiduciary. Like I said, we don't give advice or we don't give tax advice or anything like that. But we provide all the custodial and record keeping services to enable you to invest in non-traditional assets inside your retirement account. I'll explain what that means in a minute. So for anybody who's watching this, if you are considering making any investments, we highly encourage you to have advisors and CPAs and consultants and people like that, realtors that you work with. Because that's not the service that we provide. We're just custodians and record keepers of retirement accounts. This is what we're going to talk about. I'm going to give a quick overview about Entrust and what is a self-directed IRA. Then we're going to focus specifically on investing in real estate in an IRA. Get into some of the rules around it, around disqualified persons and prohibited transactions, important. How you can buy the different funding options of buying real estate inside your retirement account. And then we're going to give some example transactions, and then how you get started, and then we'll have a Q&A at the end. So this is me. I've been with Entrust actually coming up on 11 years. And my role as business development manager is I do what I'm about to do, which is educate people on how they can invest in non-traditional assets inside your retirement account. By the way, a non-traditional asset is considered anything other than a stock, bond, or mutual fund. So real estate, private placements, precious metals, promissory notes, tax liens, trust deeds, I could go on and on. We currently have about $4 billion. We've had over the course of our career about 45,000 investors, more than that at this point. We currently have about 22,000 account holders. We've been in business for over 40 years, and the way we differentiate ourselves from our competitors, we provide a single point of contact. So anybody who opens an account with Entrust, you get me, or at least if you're in my region, you get me and my associate Jacob as your point of contact with most of our competitors. Once you establish an account, you're going to get an 800 number and get whoever happens to answer the phone. So that's one of the ways that we differentiate ourselves and try and provide particular high level of service. So as I mentioned, we are, it says here, self-directed IRA administrators. That's another way to phrase it. I prefer to say custodians and record keepers. So anytime you have a retirement account, it requires you to have a financial institution to act as custodian. Most people's custodian is a bank or a brokerage firm. So we provide all the same custodial services. We have our own trust company. We're a financial services company who provides the custodial and record keeping services only. When you have an account with a brokerage firm, they also provide advisory services. And that's what differentiates what's a self-directed retirement account with us versus one that's not truly self-directed, is that those companies limit you to stocks, bonds, mutual funds, but they provide advisory services. We don't give you the advisory services, but you can invest in things other than just stocks, bonds, and mutual funds. We have offices throughout the United States, but we're headquartered in Oakland. And we have a lot of educational content, and we do a lot of educational events and seminars and webinars like we're doing today. So what exactly is a self-directed IRA? What's the definition? First of all, I'm going to tell you what it's not. A self-directed IRA is not a type of account. It's a description of the service we provide. Self-directed is a description of the service we provide. So a self-directed, as I said already, IRA means, one, you make your own investment decisions. We don't provide any advice for you. And two, you can invest in non-traditional assets. So if you have an account with, let's say, just to throw out a name, Fidelity, and they tell you you have a self-directed account because you're not going to get any advice from them, you're going to do your own stock trading. It's not truly self-directed, because with them, they're not going to let you invest in real estate or invest in precious metals or invest in promissory notes or any of the other things that fall under what's considered non-traditional assets. You're limited to just the assets that they allow, which are stocks, bonds, mutual funds, right? So that's not truly self-directed if they limit what you're allowed to invest in. So a self-directed IRA means that you make all your own investment decisions. You're in charge of all the investment decisions, and you can invest in things outside of just stocks, bonds, and mutual funds into other non-traditional assets. But in order for it to be a retirement account, to be an IRA or a 401k, it requires a custodian or a trustee, right? And so that's, again, the role that we play. Just like a Fidelity or Merrill Lynch's Charles Schwab, where they're a custodian or a trustee, so are we, okay? So what are the benefits of self-direction? One, you get more control over your investment decisions. Again, if you're familiar with real estate, if you're comfortable investing in real estate, this allows you to invest in real estate. If there's some startup company that you're familiar with that you think you want to invest in and grow inside your retirement account, a self-directed IRA gives you the flexibility to do that. So you can diversify and not just be limited to what happens in the market. And then you get the tax benefits of growing that asset inside your retirement account. So when you buy real estate as a personal investment, and then you're getting rental income on an annual basis, you have to report that income on your taxes, right? Now you get to also write off expenses like depreciation, but when that asset is held inside your retirement account, the income from the property goes directly to your retirement account. So it grows tax sheltered because the asset is owned by your retirement account. Any revenue that's generated from the investment stays inside the account until you take it out as a withdrawal, and then it becomes a taxable event at that point. So it's a way to grow your retirement account by making alternative investments tax sheltered until you want to start taking the money out as a withdrawal. So what exactly is a real estate IRA? If you come across the term real estate IRA, it just means that you're invested in real estate inside your IRA. Again, like self-directed is not a type of account, it's a description of the service. Real estate IRA is not a type of IRA, it's just a description of the asset that you invest in. It's more of a marketing term that promotes the idea that you can invest in real estate using your retirement account. So what are the types of retirement accounts? Traditional IRA, Roth IRA, SEP IRA, Simple IRA, and individual 401ks. Those are the type of retirement accounts that you can establish with Entrust. There are things like pension plans, defined benefit plans. We don't offer those types of plans. Not many people use those. You'd have to be a business owner, et cetera, but within what are considered, standard retirement. There are also 403Bs, 457Bs for people who work for nonprofits or work for governmental organizations. Those are basically the equivalent of a 401k. But what we have is an individual 401k, a simple IRA, SEP IRA, traditional IRA, and Roth IRA. So I have a quick slide here if there's any real estate professionals, realtors, or anybody like that who's watching this. Why is it important that you know about self-directed IRAs? Well, one, you guys have your own business. Hopefully you are contributing to a SEP IRA or an individual 401k. This gives you the flexibility to invest inside your retirement account into an asset class that you're most familiar with, real estate. You, as the business owner, because you can set up an employer-sponsored plan like a SEP IRA or 401k, allows you to make much higher contributions than a traditional IRA or a Roth IRA allows. And it also, if you know about this and you potentially have clients who want to invest in real estate but don't think they have the money, well, maybe they have an old 401k with a company they used to work for where they have a lot of money. You can propose the idea of them investing in real estate using their retirement accounts. There's it's even over 7 trillion. This is kind of an old number. There's a significant trillions of dollars that are currently in retirement accounts. So there's a lot of money that's held in retirement accounts. Real estate is by far and away the number one investment that's held inside a self-directed IRA. So again, by knowing this, being aware, because there are a lot of people who aren't aware of self-directed IRAs, not only other realtors, but also a lot of your clients aren't going to be aware that real estate is an asset that they're able to and allowed to invest inside your retirement account. So potentially it gives you the opportunity to sell more houses, close more deals. But again, I haven't mentioned this, but any investment inside a retirement account has to be for investment purposes only. We're going to get into this a little bit more when we talk about prohibited transactions. But if you buy real estate inside your retirement account, you can't use it as a vacation home, a second home, a primary residence. It has to be for investment purposes only. We're going to explore this in a little bit more detail when we get further along. So what kind of real estate can you invest inside? Or actually not even just real estate, but what can you invest in inside a retirement account? I'm going to take your eyes to the very bottom bullet point, almost anything. You're allowed to invest in almost anything inside your retirement account. Real estate, obviously, we listed a bunch of different types of real estate: single and multifamily, commercial property, land, limited liability corporations, offshore real estate, co-ops, notes. People do notes quite frequently inside their retirement account. Almost anything. What aren't you allowed to invest in? These are the only things you're not allowed to invest in. Collectibles, which can include a work of art, an antique, a gem. You notice some metals and stamps and coins have an asterisk next to it. So there are certain metals, precious metals, that are allowed to be invested in as long as they have a certain fineness or purity. That's gold, silver, platinum, and palladium. So there are dealers out there that you can use your retirement account to go buy gold. That gold gets shipped to a depository. Now your IRA owns that gold. Okay. Alcoholic beverages like wine, you can't own wine inside your IRA. Then life insurance and S corporations. So you're allowed to invest in any corporate structure except for S corporations. So you can invest in C corps, LLCs, limited partnerships. S corps, though, because of the way they file their taxes, you're not allowed to invest in those corporate structures inside your retirement account. So I mentioned a little bit earlier about rules around disqualified persons and prohibited transactions. Essentially, any investment that you make inside your retirement account has to be purely for the benefit of the retirement account. So there are certain people that are considered disqualified that aren't allowed to receive an immediate benefit. And I'm going to give you some examples of what are considered prohibited transactions, but here's the list of disqualified persons. You as the account holder, your spouse, your ancestors, so parents, grandparents, etc., your lineal descendants, so children, grandchildren, etc., and then any spouses of lineal descendants. Then anyone with 50% ownership, that whole thing, that gets into if you want to invest into a privately held company. If you have personal ownership in that company, then there gets into percentages of how much personal ownership you're allowed to have in that company before your IRA can invest in it. I'm not going to get too far down that line. We're going to focus a little more on the idea of investing in real estate, and what it means when you're a disqualified person for real estate. So what is a prohibited transaction? It's an improper use of the IRA by the plan participant or a disqualified person as a prohibited transaction. So what are some examples of prohibited transactions or a proper use? Your IRA is allowed to borrow money, right? So if you want to buy a property and it's worth more than the money that's in your retirement account, your IRA can borrow money from a financial institution or any private money lender or even a friend, but it can't borrow money from a disqualified person. You can't loan your IRA money. Your spouse can't loan your IRA money. Your parents can't loan your IRA money. Your children can't loan your IRA money, right? You can't borrow from a disqualified person. You can't sell a property to a disqualified person. So let's say your IRA buys a property and you want to sell it. That's fine, but you can't sell it to yourself. You can take it as a distribution, but you can't buy that property from your IRA, nor can your spouse, your ancestors, your lineal descendants, anybody that's considered a disqualified person. You can't use your IRA or plan as a security for you to go borrow money personally. Right? So if your IRA holds a property and you decide that you need to borrow money, you can't go to a bank and put that property up as collateral for you personally to borrow the money, right? Now, I mentioned the IRA can borrow the money, but you personally can't borrow the money based on anything that's held inside your IRA, right? The IRA owns the property, only the IRA can borrow money. But if you go and personally say, I want to borrow money and I want to use this property held inside my IRA as collateral, that's prohibited. You're not allowed to do that. The bank's not allowed to loan to you based on that as collateral. Buying property, I mentioned this one already. You can't use a property for personal use when your IRA buys a property. Now, not only you, but also any other disqualified person. So if you buy a rental property inside your IRA, you can't have your kids rent that from you or your parents rent that from you, right? A disqualified person can't use it for personal use. And then you can't invest in a company that's owned by a disqualified person. So we talked about that briefly where it said 50% ownership. It gets into percentage ownership. So you can have like personal investment in a company and still have your IRA invest, depending upon the role you have in that company. If you're a passive investor versus if you are actively involved in running the company, and depending upon how much personal ownership you already have in the company. Now, again, this is more of a real estate focused presentation, but if anybody wants to, understand this a little better, we can have some conversations. I'm also going to mention one thing we didn't say on here: buying a property for personal use with IRA, you can't stay in the property. Also, a disqualified person can't do any physical labor on a property, right? So no sweat equity. So if you use your IRA to buy a property, you, your spouse, your ancestors, your lineal descendants can't put any physical labor into it. You can't paint it. You can't go repair things. You can't cut the grass. No sweat equity is allowed by a disqualified person on a property that's owned by an IRA. So how can you buy real estate using your retirement account? You can buy it with cash. There's a property out there worth $300,000. You have $350,000 in your IRA. You buy it all with cash. You can partner your IRA with other investors, including what would normally be a disqualified person, as long as you're doing that partnering arrangement at the time of investment. So what I mean by that is, if you have an IRA and your spouse has an IRA and you each have $200,000 in your IRA and you want to buy a property for $300,000, you can take $150,000 from one IRA and $150,000 from the other IRA and partner them together. And now your IRA owns 50% and your partner's IRA owns 50% of that property, right? So that's called partnering. You can partner with yourself. If you have, again, using the same figures, you have $200,000 in your IRA and $200,000 in your personal savings. There's a property for $300,000. You can take $150 from your IRA and $150 from your personal savings, partner them together. Now your IRA owns 50% and you personally own 50% of that property, right? So that's called partnering. And I'm using 50-50 as an example, but like the percentages would be based on whatever amount of money comes from each partner. You can have multiple partners. There are people who do syndications that is in effect a really, really large partnering of investors, some of which are sometimes IRAs. Leveraging and debt financing, as I already mentioned, an IRA can borrow money. There are financial institutions that'll do that. And then finally, limited liability corporation. So let's go through these in a little bit of greater detail. So using a direct purchase, it's the quickest, it's the most straightforward. You simply use the cash that's inside your IRA. Okay. So here's an example. You want to purchase a rental property near Lake Tahoe. Let's say, you're familiar with the area, you think it's beautiful, you think it's a good investment, you want to buy something there. Title on that property is held in the name of the IRA. So throughout this presentation so far, I've been talking about your IRA owns the property, your IRA owns the property. This is what I mean by that. Your IRA has its own name and it has its own tax ID number. So it's not you that's buying the property, it's your retirement account. So if you want to buy a property, again, in this example in Lake Tahoe, when you draw up the contract and all the closing documents, the name of the buyer with Entrust is going to be the Entrust Group for benefit of, is what FBO stands for. The Entrust Group, FBO, your name, account number, whatever your Entrust account number is going to be. It starts off 723. We have 10-digit account numbers start off 72300. So that's going to be your account number. That's the entity that will own that property. So your purchase contract, since it's the IRA that's buying the property and we're the custodian of the IRA, we are the signatory on behalf of the IRA, not you. So that contract and all the closing documents, when it needs to be signed, it's signed by us, but it's done at your instruction. Right. So we have a process where you and the margins write read and approved and sign next to that and then forward it to us for signature, because all the processing is done by the custodian, but everything is done at your instruction. So any earnest money must be paid from the IRA. If you have to come up with earnest money, the IRA pays that. The IRA is buying the property. The IRA is responsible for all the payments. That includes rents and expenses. So if you're renting it out, the rent doesn't go to you because you don't own the property. The rent goes to the IRA because the IRA owns the property. Same thing with expenses like property taxes, insurance, maintenance. You send the bills to us, we pay it out of the account, right? Everything's done at your instruction, again, but it's the IRA that owns the property. We're the custodian. We follow your instructions. You decide who you're going to rent it to. If you're going to rent it at all, you decide if you're going to have a property manager. You're allowed to go to the property if maintenance needs to be done. You decide what contractor you're going to hire. You decide what work's going to be done. If anything, if you're going to furnish it, all of those are your decisions, right? We don't decide that. We don't manage the property for you. We custody and administer the account. So when it comes to actual money going into and out of the account, it's done at your instruction, but it has to go into and out of the account. You have to tell us whenever a check needs to be cut or whenever rent needs to come in. And as I mentioned, you can't stay there, right? The disqualified person can't use it for personal use, and also no sweat equity. So you can't do physical labor on it. Partnering. I went over this in a fair amount of detail. You can partner with, at initial investment, at a new investment, you can partner with anyone, including what would normally be a disqualified person. The ownership is going to be proportionate to the amount that each of the partners is investing into that investment, right? So another example, you want to use your IRA and partner with someone else to buy a property near a college campus, UC Davis. So husband and wife IRAs are the partners, again, permitted at the time of purchase only. So what that means is if a husband uses their IRA to buy 100% of the property, you can't add the spouse's IRA on at a little later date. Once that property closes, the IRA, now that spouse's IRA is considered a disqualified person. But if you want to partner, you have to do it at the time of investment. Excuse me. Each invest 50% of the purchase price. I gave this example earlier. Title is held in the names of each IRA with the listed ownership percentage. So it would be the entrust group for benefit of spouse number one, IRA number one at 50%. The entrust group, FBO spouse number two, account number two, 50%, or 80, 20, 70, 30, whatever percentages match up to the amount of money that each account is contributing. Right now, if you have a partnering arrangement like this, where it's 50-50, that means that each account receives 50% of the income. Each account is responsible for 50% of the expenses, right? Again, it correlates to whatever the percentage ownership is. If you set up a 70-30, then the 70% owner receives 70% of the rent and pays 70% of the bills. And a daughter in this example, or a lineal descendant, would be considered a disqualified person. So if you have a child that's going to school at UC Davis, that you bought a property there, that child is not allowed to use the property, whether it's a fair rent or for free, and they can't do physical labor on it, right? So those are the things that are considered prohibited transactions. Debt financing, what is called a non-recourse loan. So there are financial institutions that will lend your IRA money. It has to be structured as a non-recourse loan. What that means is that the note is secured solely by the property that is being borrowed on. So you can't provide any personal guarantees. You can't use any other assets inside as a collateral. Let's say this is the second property that you're buying inside your retirement account. The first property can't be used as collateral. It can't be foreclosed on, right? So the lender, in the event of default, their only recourse is to foreclose on the property. They can't go after you personally. They can't go after other cash in your IRA. They can't go after other assets inside your IRA, right? Solely non-recourse loan. So the IRA is the borrower, right? So on that note document, the borrower is going to be the entrust group, FBO, your name and account number. We would be the signatory on the agreement because we're the signatory for all paperwork associated with your IRA. So the loan agreement would have to come to us for a signature, but you go find the lender. Now, we have a list of lenders on our website that we know do non-recourse loans to IRAs. You're probably not going to be able to get one from a conventional lender, right? So like your typical, with the realtors who are seeing this, like the typical realtors that you work with are probably not going to do non-recourse loans to IRAs. So we do have a list of those that we know do it on our website. You're going to get a little more strict loan to value, 65, 70%. You might even get 60%. You might have to come up with 40% down. What it says, no credit check, what that means is that the individual is not the borrower. The IRA is the borrower. So doing a credit check on the individual is not applicable because the individual is not the borrower, right? They're going to be looking at your retirement account, how much cash is in there, how much are you putting down, what's the expected rent on the property. Basically, they're going to determine the account's ability, the retirement account's ability to pay the loan. Unrelated debt financed income tax may apply. All right, now I'm going to give a real quick summary of what that means. If let's say you have an IRA and you borrow 50%, I'm going to use really simple numbers here. These won't be California numbers, but let's say there's a property for $200,000 and you have $100,000 in your IRA and you're going to borrow the other $100,000, right? Let's say at the end of the year, you earn income on that property of $10,000. What the IRS looks at that and says, okay, well, of that $10,000, $5,000 of that was earned by your IRA income because it was 50% came from the other IRA, but the other 50% came from outside the IRA. It was borrowed money. So that other 50% is not tax sheltered, which means you have to pay income tax on the percentage of income that came from non-IRA money. In other words, the borrowed money, right? Now, those are tax rates that are graduated just like income tax. They're trust rates. So there's a trust tax table that's a little different from the income tax table, but the percentages are the same. They just start at a lower dollar amount, right? So it still starts at like up to like, you know, a certain, like if you earn up to, I don't know, $1,800, or actually it's not that high, but if you earn up to a certain dollar amount, there's no tax rate. Then it becomes 12%, then 16%, then 20%, and similar to what our income tables are. But it's based on a trust tax table. But the point of this is that if you're using leverage, then this is another expense that your IRA is probably going to have to pay, similar to how it has to pay property tax, how it has to pay maintenance, how it has to pay insurance. Like those are expenses. So if you're considering investing in real estate using your retirement account, and you want to, you know, have an idea of what your expected return on investment is, obviously return on investment is going to be income generated minus expenses. That nets out to whatever your ROI is. This is another expense to consider if you're using leverage. Okay, I hope that all made sense. And then finally, this you can fund it by setting up an LLC. So if any of you like decide to do some research on self-directed IRAs or go read some things, or if you've already done so, you might want to cross the term checkbook IRA or checkbook control LLC. This is what it means. So everything that we've been talking about so far has been talking about using your IRA to hold direct title on the property, right? The owner of the property is going to be the Entrust Group, FBO, et cetera, et cetera. But Entrust holds the money, and you instruct us anytime a bill needs to be paid, and we send the money to the contractor, to, you know, the state to pay the property tax or whatever, right? But there is a way for you as the account holder to achieve checkbook control over your IRA funds where you're writing the checks, right? And the way to do that is through a single member LLC, where you name your IRA as the member. So instead of the IRA buying a property, you set up an LLC where you name the IRA as the single owner or sole member of the LLC, but you can name yourself as the manager of that LLC. So as the manager of the LLC, not only are you setting up the LLC, we don't set it up for you, you would set it up or hire somebody to set it up. You set up the bank account, you're the signatory as the manager on behalf of the LLC and on behalf of the bank account. So instead of the IRA buying a property directly, the IRA invests in the LLC. The IRA becomes the member of the LLC, and now you use that LLC as a pass-through entity to go buy properties, right? And so on title on that property would be the LLC. Now the LLC is owned by the IRA, but you're the manager of the LLC, which means you're the signatory. So instead of you having to send the purchase contract and all the closing documents for a signature when the IRA holds title, you're now the signatory on behalf of the LLC. So the LLC is going to be on title, and you're going to be signing the documents, and you're the signatory on behalf of the bank account. So when you have to pay mortgages or rental, or I'm sorry, if you have to pay expenses like maintenance or anything like that, or the rent is coming in, it's going to the LLC. It's not, and it's being paid from the LLC with you as the signatory. Now, if you decide at some point you want to take that money as a withdrawal, then the money has to go from the IRA or from the LLC back to the IRA, and then you take the withdrawal from the LLC or from the IRA, I'm sorry, because the IRA still owns the LLC. You can't simply take a personal withdrawal from the LLC. You don't own the LLC. The IRA owns the LLC, right? So in effect, the LLC is simply a pass-through entity giving you checkbook control over your funds. So what are the pros of that? What are the advantages? You get checkbook control, you get more immediate access to your funds. Potentially, you could get some savings on fees of the custodian, depending upon how they charge fees. And you get certain limited liability protection when you have it under an LLC. Although I did this presentation one time and there was a lawyer there, and he said that the IRA provides every bit the limited liability protection that the LLC does. So, you know, take that as you want. The disadvantages. There are potentially costs to set up an LLC. If you don't have, you know, if you're not a lawyer, don't have the comfort level or experience to set up an LLC, you're probably gonna have to pay somebody to do that. Again, Entrust doesn't do that. We don't set up the LLC for you. But we can certainly refer you to companies and other people who have set up LLCs for other clients of Entrust. Some of them give discounts whenever we refer, et cetera, et cetera. So if it's something you want to do, let us know, and we can provide you a list of a bunch of contacts who do that. Because the LLC, you're the manager of the LLC, you're now responsible for record keeping under that LLC, right? So if you're paying bills on behalf of the LLC, those bills have to be only bills that are associated with the assets held inside the LLC. So either the LLC expense or the property under that LLC, those are the only expenses. So you can't take that LLC money and go buy your groceries with it. That would be a prohibited transaction, right? And now you're setting up yourself for potential, if you were ever to get audited, potentially have a problem with that, right? Put your IRA at risk. Whereas if you don't have an LLC and everything's funneling through Entrust, you send us a grocery bill, we're going to reject it and say you can't do that. That's not a bill associated with the property. Maybe subject to state taxes and filings. It's probably not going to be subject to state taxes, but there's a good chance that the IRA, the LLC will have to file a form, right? So just bear that in mind that, you know, those are sort of the pros and cons. Typically the cost of having an LLC, like you're also not only the cost to set it up, but also like most states, California has an $800 a year fee you have to pay to have an LLC. That's not a fee you'll have to pay if you don't have an LLC. So, you know, just, you know, bear that in mind that an LLC potentially comes with costs. I'm not talking about cost and trust. I mean, our fees are pretty flat. They're the same whether you have an LLC, whether you have a property, it's going to be the same fees. So we're talking about potential other fees associated with the LLC. So that's my presentation. To get started, it's really straightforward. You open an account with Entrust. That takes about 10 minutes. Then you fund the account. You transfer a rollover or make an annual contribution, transfer a rollover from your current custodian to your Entrust account. And then you instruct us to make whatever investment you want to make. And again, the way that is done is by submitting the paperwork for whatever investment you want to make. If it's a property, it's going to start with the contract. If it's an LLC, it's going to be an operating agreement. If you decide you want to do notes, it's going to be the promissory note. If you're going to invest in a private company or private fund, it's going to be a subscription agreement. So depending upon what investment you want to make, the investment agreement has to be submitted to Entrust in the name of the IRA as the investor for review and signature. And then we send the money directly to the investment, right? So if it's a property, we're sending the money directly to the seller or to escrow or to title. If it's a note, we're sending the money directly to the borrower. We're not sending the money to you and then you go and take it and buy the property. You instruct us to send it directly to the, you know, the people involved for the purchase, the seller. To summarize, what is a self-directed IRA? It allows you to invest in non-traditional assets. And, you know, our focus here was more around real estate, which is the most popular investment inside a self-directed IRA. You can either buy it with cash, you can partner your IRA with other investors, you can set up an LLC. By the way, the single member LLC, you can also partner into an LLC, right? So if you have like the example we used earlier with the spouses, where they partnered 50-50 in the property, your spouses, you could also partner into the LLC, and then you have a single entity, the LLC buys the property, right? But the LLC would have two owners, would have the two IRAs. So the concept remains the same. And then you can use debt financing, you know, be aware of unrelated debt financed income tax. Do your due diligence, because we're not going to do any due diligence on the investment you make, right? We're strictly a custodian and record keeper. It's your responsibility to do any research and due diligence and talk to advisors and CPAs and make sure you're comfortable with the investment you're making. Work with a good IRA administrator and custodian. Work with, you know, realtors and title companies, hopefully who have some familiarity with self-directed IRAs, but it's not necessarily a requirement. I mean, I can explain things pretty quickly to anybody who needs to know. The titling of the asset, again, the Entrust Group, FBO, your name and account number. And then as far as property management is concerned, there's no rule that says you can't self-manage a property. There is a rule against you paying yourself to manage the property. There are rules against you doing physical labor on the property, right? But if there's no rule that says that you have to go and hire a property manager to manage the property. So make that decision on your own, whether you're going to do that or not. So with that being said, here's my information in case you want to email or call me. If you guys have any questions, I'll leave this up here for a couple minutes and let me know if you have any questions.
Hey, Bill, thank you so much. Great presentation. So you had touched on manager, I had a question about management and whether you could manage yourself, and you answered that, but you cannot pay yourself to manage it, or can you pay a disqualified person to do any repairs?
Right, it would have to be a non-disqualified third party, right? If you have a property manager or if you're having somebody do work, that again, like from when we talk about management, if you're talking about like interviewing the tenant or going and showing contractors what work needs to be done or going and exploring the property before you hire, like you're allowed to do that. You're allowed to have a non-disqualified person do that as long as they're not being paid for it. But when it gets to the actual sweat equity on the property, you're not allowed. Now, where it can get complicated, and I would, urge people to be very careful, is if you or a disqualified person, you're hiring somebody whose role in life, who their job or career is property manager, right? If you're having a property inside your IRA and you're a property manager as a career, right? Like that's what you do for a living. It could be considered, based on what's written in the Internal Revenue Code, that you're providing a service to your IRA that is your profession, that could be considered disqualified, like a prohibited transaction. So you want to be really careful. Like if you're just some person who is buying a property using your IRA and you're an engineer, right? And something like that. And you don't want to hire a property manager because you're just, you're going to interview tenants and they're going to call you whenever they need any work. I don't think there's any issue associated with that. Again, as long as you're not taking like 10% of the rent as income to manage the property. But if your role is actually as a property manager, and even if you're not paying yourself, the way the Internal Revenue Code is written around providing a service to your IRA, that potentially could be considered a prohibited transaction. And prohibited transactions, committing a prohibited transaction puts the viability of your IRA at risk, right? If you were to get audited and they determine that you committed a prohibited transaction inside your IRA, they could disqualify your IRA as an entity entirely at the time the prohibited transaction occurred, which means any transaction that occurred after that are now taxable, plus it's a taxable distribution to you. So, you want to be careful around that.
Well, I mean, what about a simple changing a light bulb? I mean, kind of ridiculous, but I mean, is that you?
I mean, if you want, okay. It's a good question. I don't know that like I'm equipped to sit here and say absolutely this or absolutely not that, right? If you look at the letter of the code, right? If you look at specifically what it says, that would be considered a prohibited transaction.
Wow.
Now, would they actually enforce that? Or is there even a chance that anybody would catch you changing the light bulb? Probably not, right? Like, I mean, what's the real sort of risk around that? And if you talk to somebody with the IRS, they might very well go, or the Department of Labor, who oversees qualified plans, they might go, absolutely not. We don't give a crap about that, right? But from a conservative standpoint of reading the code, that would be considered like labor, right? Like as with
why
cutting
risk
the
it,
grass.
in other words?
Yeah, I mean, it's so I can't sit here and I don't have anything like where there isn't like a list of things you can and can't do that it says in the code where it says like changing a light bulb is okay, right? It just says, it just talks about the staying in the property, like disqualified persons can't get personal benefit. I mean, what they look at that is providing a service is almost like an end around the contribution limits, right? Like there's limits on how much you can make in a contribution to an IRA. Like a traditional IRA or Roth IRA is $6,000. Unless you're 50 or older, then it's $7,000. A SEP IRA is, I think, $61,000. 401k, same thing. And if you're providing labor for free, then that's almost like and also contributions have to be in cash. So if you're providing labor on a property inside your IRA, you're in effect providing a disqualified contribution to your retirement account. You're potentially increasing the value of an asset by providing labor to it, right? So I think that's the thought process behind it.
The regular maintenance doesn't add value. It maintains
maintains
it.
value, right? So I mean, look, I mean, I haven't written the code or, even had a conversation with somebody with the IRS around specifics associated with it. And I get, these are like the very common questions I get around,
Yeah.
well, how would they know? Like if I went and cut the grass, how would they know? Or if I changed the light bulb, how would they know? It's like, look, I'm not going to argue with you. They probably wouldn't. And to be honest,
Yeah.
like we have people who have properties inside their retirement account. Do we know that like 100% of them aren't, going and changing light bulbs or cleaning it between tenants and stuff like that, even though they're not allowed? We don't know. Like, it's not like we have a camera on it or anything like that. Right. So, but I mean, somebody once asked for me to give a scenario. So here's a scenario that I've given more than once in terms of like, well, how could you potentially get caught? Let's say you've got a neighbor who, for whatever reason, doesn't like you, and they know that your IRA owns the property and they see you cutting the grass, right? They very well could turn you in, right? Like, so is it likely? No, it's not likely. But I mean, it is a scenario, right?
Yeah,
Or you get into a lawsuit with a tenant and everything comes out.
Something like that. Yeah,
and
exactly. That's even a better example, probably,
Yeah.
than what I've been given. Yeah, exactly.
So since we're talking about tenants, how is rent collected? How are they paying their rent?
Well, they would, I mean, however you tell them to, right? So they can either send a check, they can send a wire, they can send a ACH. They would either send it so we have our delivery instructions.
And it's made out to the
LLC, or I'm sorry, either the LLC or the
IRA.
It would made out
FSB.
exactly. I'm trying to stop my screen sharing here. Let me do this. Okay, there we go. Yes,
like
exactly. They would send the money directly to the IRA or directly to the LLC. So with us, we have delivery instructions that say, if you want to send a check, here's our address. If you want to send a wire, here's our wire instructions, to send an ACH. Now you're allowed to, if you want to have them send a check to you, like you just want to ensure that you're getting the rent every time. So you say, send me the check, or you just don't want to tell them whatever. I mean, they could theoretically, you could tell them just don't make the check out to anybody, just write the dollar amount and send it to us. And then you fill in the Entrust Group, FBA, your name and account number, and forward it to us. That's fine. Nothing says that the tenant has to send it directly. But what the rules say is that you can't deposit the money into either your own account or an account that you've set up for the IRA. Now, you can deposit directly to the LLC. If you structure it through it has to be through an LLC. But you can't take the money and deposit it into a bank account and then turn around and send it from that bank account to Entrust. But they can send you the check so that you can record it and then you forward it on to us. Yeah, but it either they have to make it out to the IRA or leave it blank and you make it out to the IRA.
Okay.
So sorry, we've got a lot of questions here. If you're partnered with your IRA, let's say IRA pays 200, we pay 200, and so when you're collecting the rents, and that rent isn't, let's say you have two tenants, but the rent isn't proportional, who would deposit? Does a check go to Entrust, and then Entrust would give us our half, or how does that happen? Or does the tenant have to write two separate checks?
Yeah, that one. They would have to send out two separate checks. Yeah. So if one's an IRA and the other one's just your own personal funds, then, you tell the tenant how to send the money, but no, they don't send all the money to Entrust and we send the money to you. They send your money and they send Entrust its money, right? Based on the percentage ownership.
So this is where a property management company would probably come in.
It can be pretty handy. Yeah. Have them send it to the property manager and then the property manager. Also, the property manager, and this is how I do it with my property that I have in my IRA, which is out of state, and I have a property manager, is the tenant sends the money to the property manager. I just have them keep the money. And then, so I've actually have a partnering arrangement between my IRA and my health savings account into this property, right? So my IRA owns 90% of it. My HSA owns 10% of it. And instead of having them send the money every month to my two different accounts, and then every time we need a bill pay, have the two accounts pay the bill, I just have the property manager hold the money and pay the bills when they come, right? So they receive the rental income, and then whenever property tax bill comes or whenever maintenance needs to be done, they already have a bank account that they're writing one check from. And then once a year or so, or it's actually even been less that often for me, then I say, hey, take, all but $500 and send money to my 2 accounts, right? And keep the rest of it and just keep growing it and pay bills. And I'll call you again in another year or 2 to send more money to the 2 accounts. So that's allowed because the property manager is a non-disqualified third party. Right. So you as a disqualified person, you as the account holder or any other disqualified person can't hold the money in an account because you're a disqualified person. But if you want to have the tenant pay a third party like a property manager, or honestly, any non-disqualified third party, you could have a sibling. Because if you notice the list of disqualified persons, it's not family, it's very specifically
direct lineage.
Yeah, exactly. So it could be a sibling, it could be a friend, it could be a cousin. They could, in effect, receive the money and keep that account and then parse out the money. It doesn't just have to be it just can't be a disqualified person that's receiving the money.
So in terms of going back to expenses, what happens if the IRA doesn't have enough funds to pay for expenses?
Then you got to get more money in the account to pay the expenses. I mean, either
you
transfer, roll over more money, or make an annual contribution, or the final option, as we said, the IRA can borrow money. Find somebody who will lend the IRA money. Now, that loan doesn't have to be like from a financial institution. Again, if you have a non-disqualified third party, like a sibling or a cousin or somebody like that, who is willing to lend your IRA money to, as a short-term basis to cover those expenses, they're allowed. Now you have to draw up a loan agreement, right? Because if getting lent to the IRA, we as custodian have to see some kind of an agreement. So you'd have to draw up a loan agreement with some amount of interest to be paid. Like it has to be formal. You can't, they can't just send your IRA money, you'd have to draw something up. But yeah, and then you can also make an annual contribution, assuming you haven't already, met your contribution limits. Or if you've got another retirement account, like if you've opened the account with us and only transferred 50% of your money, then transfer some more money over. But it's got to be paid out of the IRA. You can't just cover it out of your personal pocket.
Okay.
You
had a question?
Yeah, I do. So if you are, let's say to keep it simple, if you got a 50% loan, so you put down 50 and you got a 50% loan on it, you had said that loan income is not, or is potentially taxable.
Right.
Who pays the mortgage on that? Who pays the loan? Does it come out of the IRA, or you personally, or?
No. I mean, the IRA is borrowing the money, so the IRA pays the mortgage back, and then the IRA also would pay any UDFI, right? So at the end of the year, it's up to you to calculate, and there's a form 990T that has to be filed that details what it's UBIT, UDFI. You'll kind of hear both terms there. UBIT is unrelated business income tax, or unrelated debt finance income tax. They're kind of opposite sides of the same coin, but that's the form that needs to be filed. So if you use leverage, first of all, the IRA is paying that mortgage every month. Now, if you partner into an LLC and then the LLC borrows the money, then the LLC is going to pay the mortgage, right? And then now you've got like a partnering arrangement where you might have an IRA with part of the money and your personal funds with part of it. And so if there is borrowed money, then only the IRA's portion has to pay UDFI. And so now you're calculating, like, if the IRA owns 50% and the LLC borrowed 50%, well, now you're actually talking about 25% of the income, because 50% of the income went to the individual. The other 50% went to the IRA, and it's 50% of that 50%, right? I didn't mean to complicate things, but I just want to be clear that whoever borrowed the money has to pay the mortgage. So if you structure it through an LLC and the LLC borrows the money, the LLC pays the mortgage. If the IRA borrows the money, the IRA pays the mortgage. If there's UDFI, it's always going to be the IRA that's responsible for paying the UDFI.
Okay. Now you kind of touched on this, and I just want to clarify. So if you purchase a property with your IRA, and then down the road you say, you know what, can you sell a portion of it, half of it, to a qualified
non-disqualified third party?
Third party.
Yeah.
You can't sell a portion of it.
Sure.
You
Absolutely.
just can't. So like a spouse would be a disqualified person.
Right?
But a sibling or a friend or whatever, you can sell half of it.
Yeah.
So you find that you need a little more money in your IRA or something, you can sell a portion of it.
Find an investor. Find somebody who wants to be an investor.
Okay. And you don't have to set up an LLC for that, right?
No.
the IRA
No,
can
no,
do
no. You'll just have to retitle the property, right? You'll have to go and record it to show that, and what was once owned 100% by the IRA is now owned 50% by the IRA and 50% by whoever buys out 50%. But I mean, you guys do that all the time, right? Like, I mean, that's the standard. It's probably unusual for somebody to sell a portion of a property, right? You're mostly dealing with 100%. But in terms of, the paperwork and having to record it and, change title and all that stuff, I mean, that's going to be a standard operating procedure.
Right. Disclosures. For disclosures on the purchase, who signs all the disclosures?
I mean, that's all part of closing documents, right?
Well, no, it's part of when you're purchasing a property, you're going to be signing a bunch of disclosures from a seller.
Yeah.
And those are signed. Buyer's basically going to be looking at it. Are they signing read and approved, and Entrust needs to sign where the buyer would sign?
On the purchase of a property?
Yeah, not the purchase agreement, but the disclosures.
Yeah, right, the disclosures.
Could be anything. Has there been
I'm
flooding
obviously unsure of the answer, which is why I'm sitting here. I mean, I work off the assumption that we sign all closing documents, but our real estate team, there might be certain documents like disclosures where we just say, no, you can go ahead and sign those, right? Like the offer, like when you're drawing up the original offer, you can sign the offer, right? It's once it becomes a contract that it has to be signed by the IRA. Disclosures might be one of those things where the account holder can sign, but I'm not positive about that answer. I'd have to go to our real estate team to see if that has to come to us.
Going back on that, what you just said, so the buyer can sign the offer?
The account holder.
The account holder can sign. So the purchaser on the purchaser line, that would be the Entrust.
That would be the IRA. Yeah.
IRA. But the signature line, because we do have, there's a form that is alternate, what's it called? I forgot, but that happens a lot with trusts and whenever there's, there is a form for that.
Yeah.
So the individual can sign that he's signing for Entrust.
Yeah. What we're trying to do is, like, a lot of times whenever, somebody's buying a property, there's back and forth. There's negotiation that goes back and forth. So we don't want that, like that offer document, like every time there's a counter offer to come back and say, okay, Entrust, you have to sign it. So it's like, you know what, once you reach an agreement, once you settle on a price, and now it's a contract, or now you're going to draw up a contract, now you need to get Entrust involved.
Okay.
Right.
So is it recommended that you just drop a new fresh contract with the right signatures, or once you're in contract, or maybe in the contract itself, it says this will be assigned to.
I think, I mean, people do it both those ways. I think, I mean, better is a relative term. I think drawing up a fresh contract is always like probably a good thing when you're dealing with an IRA, but if you're assigning it, that also works. Certainly people do that. Yeah, you can put the IRA, but I mean, ultimately by the time it closes, as long as everything's in the name of the IRA with our signature on there, you're good to go.
Okay.
Good.
I think that's all the questions we have.
That was awesome.
Well, thank you, Bill, for your time. It was amazing, and we really appreciate it. So we'll be in touch, and hopefully we can host another event and provide more value to our clients and anyone that's looking for self-directed IRA and real estate to build their wealth.
Yeah, thanks for inviting me. And like I said before, I mean, I like doing, this is my favorite part of the job, is actually doing presentations. So invite me anytime.
Hope you got some good information. And if you want any more, you can just contact us. We'd love to talk to you.
So give us a call, 916-367-8900. And Renee's direct number is 916-220-7508. Hope you have a great day.
We look forward to hearing from you.